at 4.17. Joining us now in the studio, Barry Habib, National Sales Trainer at CTX Mortgage. Barry, good morning.
Good morning.
Rates headed up.
Rates have been moving.
Period.
Yeah, they've been kind of in a range right now. We've about 1% higher than their lowest levels, but we're a little bit better than they were a few months ago. And that's because we've seen, as Greenspan said, kind of a pause in the growth of the economy. It hasn't been as hot as it was, but if Greenspan is right, and this is just a pause, and we see it pick up again, and certainly tomorrow we'll get some more clues as to that, we'll probably see rates tend to trend a little bit higher towards the end of the year. I think that that's what's going to happen.
Well, you know, Greenspan told everybody early in the year to go get an adjustable mortgage. It saves you money long term. So,
yeah, that's very, very true. And I think that adjustable rate mortgages are kind of on sale right now because the difference is approximately 1% when you consider adjustables like a 5-year adjustable when you compare them to a 30-year fixed. So they make for a terrific bargain. The problem is that over the last 3 years, you've seen approximately 80 to 85% of all loans go into the fixed rate market. And rightfully so, because rates have been trending lower and we've been in historical lows.
Right.
The thing of it is that both mortgage professionals and real estate agents and, of course, consumers have kind of had this mindset that, boy, fixed rates is all I should be looking at.
Right.
But, you know, adjustables are a screaming bargain right now. And if you take a look, now there's many, many adjustables out there, but let's just take a look at, let's say, a 5-year adjustable because it's kind of middle of the road.
This is a one that the rate is fixed for the first 5 years and then adjusts annually thereafter?
That's exactly right. That's called a 5-1 or 5-year ARM. And what happens here is that for the first 5 years, you're going to be about 1% below what a 30-year fixed would be. Now, on a $300,000 loan, that's $200 a month, so we could use some round numbers. Many people might say, you know what? I don't think I'm going to be able to move within 5 years. I think I'm going to be in this house longer than that, so I should probably avoid that. It's not really true, and there's some very good rationale why, even if you think you're going to be in this home longer, you may want to consider it. It's because you're going to save, in this example we just gave, about $200 a month. For the first 5 years, or 60 months, that's a guaranteed $12,000. If you did nothing more than shove it in a piggy bank, you're going to be ahead of the game, even if rates were to do nothing but increase through year 6, year 7, and part of year 8. So now for an 8-year period, mathematically, you're going to be cheaper than a 30-year fix would be. Within that time, there's a high probability you would have refinanced. And if you get a little creative and you say, okay, I'm going to make that payment on a 30-year fixed rate anyway, so if I get to save this $200 a month, it's a bonus by taking the 5-year. So what I'll do with it is I'll pay down my mortgage. And you prepay the mortgage every month for the first 5 years by using that savings. Well, the magic of saving the interest gives you a bonus of $17,000 now in less mortgage balance you owe, less principal balance. In other words, if that mortgage started off at $300 and normally on a 30-year it'd be down to $280 after 5 years, it's down to $263. That's
hold on, let me stop you there. So you're talking about someone who takes the adjustable rate, saves X amount of money on a monthly basis, and takes that money being saved and puts it into the principal, reducing the principal.
Precisely.
Creating a total savings of $17,000.
$17,000 after 5 years. So you're making the same payment. All you're doing is by choosing a different option. You're paying the same thing you would have as a fix to the lender.
Right.
But now you've got $17,000
$17 ahead.
$17,000 would last you, even in the worst case scenario, with rates going sky high and staying there, for a period of 10 years. The National Association of Realtors says you're going to move within that time frame. You probably would have refinanced once or twice. And if people ask themselves, when was the last time I've had a mortgage for 10 years? Or who do I know that's had a mortgage consistently, that same mortgage for 10 years? It's pretty rare. So this is a very, very useful tool for people to consider now, that 5-year adjustable. But in addition to that, something very unique could happen, is that even if rates go up in year 6, because you owe $17,000 less, your payment could actually decline because it's based on the lower principal balance. So some interesting things can happen. And many people would say, okay, Barry, you know, that's a very, very nice tool, but I'm still afraid if my payment's $400 or $500 more, you know, 7, 8, 9 years down the road, how am I going to come up with that extra cash flow? The thing that many people don't consider is what's going to happen to their income. Their income may be 5 or 6 times that increase in payment 7, 8, 9 years down the road just because of normal increases. Let's face it, if you're in an environment where interest rates are going to be pressured higher for 8 or 9 years, it's probably going to be because the economy is doing exceedingly well and wage pressure inflation will be in effect, so therefore your increases annually would be pretty solid. But even at a 4% annual increase, you'd have approximately 5 times the difference in monthly payment that you'd be making in extra money 7, 8, 9 years down the road.
Before you go, you brought a 200-year chart of something?
You know, this is another thing. People say, well, you know, what happens if interest rates go up to what they were in the early 80s. And I did bring a chart because, you know, if you take a look for 214 years, which is the data we were able to get on the 10-year Treasury. Now, mortgages are based on mortgage-backed securities, but we have the historical data on the 10-year, which will give you kind of a feel for it. If you take a look at this thing, Mark, we've been pretty darn close to 6% for almost all of this 214 years, except for roughly 10 of the 214 years. And I think we've learned a lesson from that, because when inflation got out of control in the mid to late 70s, we had to rein it in by keeping rates exceedingly high. I think that if you take a look at the way the Fed operates now, is at the hint of an economic pickup, they use the ounce of prevention versus the pound of cure.
All right. Barry, thank you very much.
Thank you.
Learned something, as I always do. Barry Habib, National Sales Trainer at CTX Mortgage.